The basics behind the MACD, or Moving Average Convergence Divergence indicator, is that it shows us when a stock price is about to change direction before it actually does, giving us a good idea of when to buy or sell. It's really popular amongst traders because it gives us two very clear signals: how strong the trend is and when it's about to change. And it doesn't just tell us if the price is going up or down, it also tells us how strong the buy or sell signal is. Some people might just use a simple moving average for their guide of when to buy or sell, but that can be a bit risky because the market conditions can change quicker than the simple moving average can keep up with. Now let's load it up in our trading platform and have a look. I'm using TD365 here, and I know a lot of my loyal subscribers use this platform as well, but if you use a different one, then not to worry, as pretty much all platforms will have this indicator built in. Now in TD365, head to the Studies button and type in MACD and select it. This will load up at the bottom of the window, and let's just resize this a bit. Right away we can see two lines and a histogram. The first line to look at is this white line here, and this is the primary MACD line, and it's calculated by subtracting the 26-day EMA from the 12-day EMA, resulting in this white line. An EMA, or exponential moving average, is an indicator that just shows the average price of something over a specific period. Now this second red line here is called the signal line, and this is a 9-day EMA of the white MACD line, which basically means it's just a nice smoothed out version of the MACD line. This line helps to identify changes in price momentum and acts as a trigger for buy and sell signals. Now in different platforms these lines may be different colours, so to check that you're looking at the right one, always remember the MACD line is the more squiggly one and the signal line is always the smoother one. The next thing we have here is the histogram, which represents the difference between the MACD and the signal line. And lastly, we have this line running right through the center, which is the baseline or the zero line. So in order to put this to use, we have to remember this overly simplified rule, which is you go long when the white MACD line crosses above the red signal line, but only when it happens underneath the baseline, okay? Or you go short when the white MACD line crosses below the red signal line, but only when it's above the baseline. Sounds a bit confusing, doesn't it? But once you've looked at it a few times, trust me, it will all sink in. So let's go over it again. It's bullish when the white MACD line crosses and goes above the red signal line, but only when it's occurring below the baseline. This suggests that the price might experience some upwards momentum, and it is a bearish signal when the white MACD line crosses and falls below the red signal line, but only when it's above the baseline. This will indicate that it's time to sell or go short. Now let me show you exactly why the MACD is more powerful than just using EMAs on their own. When you use these crossovers of the lines as a signal to place a trade, we are entering the trade much earlier than we would have done had we just used a normal moving average line, because the crossovers just seem to happen so much earlier than they do with normal moving averages alone. Let me show you what I mean by adding a 12-day EMA and a 26-day EMA to the chart. So in TD365, I'll go over to Studies and type in Moving Average, select that, and I'm going to change the period to 12 and change the type to exponential. And to make the comparison obvious, I'll use the same colors as the MACD. So I'll change the color of this one to white and hit done. That's plotted the 12-day EMA on the chart. Now to add the 26-day. So I'll do the same again. Click Studies, select Moving Average, change the period to 26, type to exponential, and I'll keep this one red. Now looking at these EMA lines, we can look at where the crossovers happen compared to where they happen on the MACD. And it's quite clear that on the MACD they happen a lot sooner, proving that the MACD gives us an earlier signal than just using EMAs alone. We can see that in this uptrend, the crossover of the EMAs happens at this point, quite a while into the uptrend movement, and we would probably enter a long position here based on this information, putting our stop loss at this point, which is quite wide. Now then, if we look at the MACD, the crossover point is way earlier, meaning we would have entered a long position at this point instead, giving us the opportunity to make a very early entry, making much more out of this price movement, and meaning our stop loss would be much tighter as well. Overall, a much better position to be in, thanks to the early signals of the MACD. So pretty powerful stuff, but there's a bit more to it than that, so stick with me. Now let's have a look at the histogram, which is made up of these red and green bars here. The histogram represents the difference between the MACD line and the signal line, giving us a visual representation of the strength and the direction of the price momentum. So the wider apart these two lines are, the longer the bars on the histogram will be, telling you how strong the movement is, possibly indicating a trade. The histogram runs along this baseline or zero line, and you can see that if the white MACD line is above the red signal line, then the histogram will also be above the baseline. And the same goes if the white MACD line is below the red signal line, then the histogram will also be below the baseline. So let's have a look at some examples of how this indicator works alongside the Dow. And you can use this indicator with anything, be it stocks, futures, or Forex. In this example, I've got the Dow Jones, or the Wall Street 30 as it's called in my broker. By the way, if you're interested in using this broker for yourself, then you can sign up with the link in the description box below. It doesn't cost you anything, but it helps me out a little if you use my link. And a huge thanks to those of you that have already done so. Right, back to the chart. So let's have a look at where the MACD shows us some bullish signals and where to possibly place a trade. We can see here that the white MACD line has crossed over and gone above the red signal line, and it's below the baseline, therefore telling us that there is bullish momentum here. And we can see where that corresponds on the chart. Let's have a look at another one here where the white MACD line crosses over and goes above the red signal line, again below the baseline, indicating bullish momentum, which you can see on the chart here as the price started to rally. Now let's have a look at some bearish signals then, and where we could possibly go short. So we look to see where the white MACD line crosses and goes underneath the red signal line, like here, and it's above the baseline, so that shows us it's bearish, and that corresponds with the price falling on the chart here, a very early indication of a downward trend. And again, we can see it here where the white MACD line crosses and goes underneath the red signal line, again above the baseline, and we look on the chart and that's exactly what's happened. The price has dropped. So everything is matching up and making sense. Well, don't be too hasty, because look here, the price has jumped up quite dramatically, and we see it corresponding as we would expect on the MACD indicator with a crossover here. But as the price continues to go up, look at the MACD, it's dropped down and it's crossed over the red signal line, creating an opposite image of what we would expect to see. This is called divergence, and this occurs when the price move is not likely to last and is an indication that the price will probably come back to where it was. And we can see that the price did in fact fall back down again shortly after, so be wary of this. If the price jumps up but the MACD does the opposite, then that's a bearish indication and tells us that the buyers have run out of steam. Put simply, if the price makes a higher high but the MACD makes a lower high, then that's a bearish signal. Same goes the other way around. If the price makes a lower low but the MACD makes a higher low, then that's a bullish signal. Now you can use this to your advantage by spotting when this is happening on the MACD indicator and placing a trade when the trend starts to reverse. Now there is one extra step that you can take to give you that extra bit of confirmation when placing a trade, and that is to use the MACD alongside a 200-day EMA. Now every trader knows that when placing a long position, we only want to trade in an uptrend. And when we place a short position, we only want to trade in a downtrend. And the MACD indicator is great at showing us when a trend is coming. However, sometimes it just isn't. And it can just give us false indications, causing us to make incorrect decisions, which can be incredibly frustrating. Remember, indicators are never an exact science. They're there to guide, not to inform. But to help us out a bit with these false signals, we can add a 200-day EMA to the chart. To do this in TD365, click on Studies, type in moving average, select that, change the period to 200, and to avoid confusion, I'm going to change the color to blue and click done. This will plot a 200-day moving average on the chart and will confirm to us that the market is in an uptrend if the price is above it, or it will confirm to us that the market is in a downtrend if the price is below it. So let's combine all this together to help us make a successful trade. If we want to buy in an uptrending market, we look to see where the white MACD line crosses over and goes above the red signal line, below the baseline. And we check that the price is above the blue 200 EMA line, signaling an uptrend. So we could make the trade here, placing our stop loss just underneath the 200 EMA line. If we want to short in a downtrending market, we look to see where the white MACD line crosses and goes under the red signal line above the baseline. And we check that the price is below the blue 200 EMA, signaling a downtrend. And we could make the trade here, placing our stop loss just above the 200 EMA line. So in this example, we can see that below the baseline, the white MACD line is crossing over and going above the red signal line. We check that the price is above the 200 EMA, signaling that this is an uptrending market, and we could make the trade here, placing our stop loss just below the 200 EMA line. And in this example of going short, we can see that above the baseline, the white MACD line is crossing over and going below the red signal line. We check that the price is below the 200 EMA, signaling that this is a downtrending market, and we could make the trade here, placing our stop loss just above the 200 EMA line. You would also use these crossover points to know when to close a trade as well. Now, you don't just want to use this indicator all by itself. Like I said, you want to use it with the 200 EMA, but you also need to be using it in conjunction with price action, as well as good old support and resistance. Always draw out your levels of support and resistance. And when it's looking like the price has touched and confirmed your key levels, then that's when you need to look at the MACD indicator to confirm whether the price will be moving in the direction you're expecting it to. Also, try to avoid trading during a period of sideways or flat movement, as the MACD will give out lots of false signals. And as always, practice this using a demo account first. And remember, this is trading and anything can happen, so be careful. Good luck. Thanks for watching, and I'll see you next time right here on Math Market.